So the way we think about risk, return, and impact is obviously our manager research team are finding the best risk-adjusted return opportunities for our clients' investment portfolios, but we always also take into account the real-world impact of those investments as well. We are not providing concessionary capital, so we're always looking for competitive market returns. However, if there is a positive impact angle to the investment, we obviously prioritise those because we recognise the benefits of those sorts of investments. We definitely think that investing in impact can improve the returns of a portfolio because you can jump onto new and emerging trends, and these tend to be growth opportunities. But we also recognise the fact that impact investments can positively impact the environmental and social environment that we're investing into, and that helps improve portfolio resilience overall. We are system investors, and we believe that there is benefit to improving that system. So I think positive impact investments actually have a better kind of risk profile. And I think part of that is to do with the fact that you are obviously avoiding negative trends, but also these investments tend to have a more positive social license. So they are less exposed to risks on that regard. And then also, obviously, our clients and members of pension schemes that we invest on behalf of obviously prefer these types of investments, or they're aligned with various values. That means that they tend to be more resilient in economic downturns. The way we think about it is that there is a Venn diagram. So you have competitive market returns on one side and impact capital on the other side. And then in the intersection of those two, you have, market rate returns plus impact. The problem is that intersection is relatively small and it varies over time as well. And it varies by market, varies by asset class. So we have to be really selective when we're finding impact investments that can be market level returns. Also, we have certain clients that are system investors, which means that they take into account the positive systemic benefits of impact investing, which means that intersection gets slightly wider for those clients. I think the one thing I can say about the future is it's going to be uncertain and it's going to be volatile. But I think if you invest in these opportunities that have, positive real world benefit, that are actually, contributing to solving systemic problems, they're going to be insulated from a lot of that volatility. The key will be, not just one client doing it, but everyone moving together into the space and helping to reduce those systemic risks.